type of loan that you're doing, depending on whether or not you're buying a very large house with a larger loan or a smaller. When determining closing costs, so excuse me, so you need to know how much money you've gotten, how much you need to spend on closing costs. And closing costs there's several components to closing costs in doing a loan. I don't know if some of you have heard the term points or paying a point on a loan. I'll expand on it here. A point basically means if you pay the bank a little bit of a premium, they will give you a lower rate. So let's say I quote you a rate on a $500,000 loan at, let's say, 4.5% with 1 point. That means you pay $5,000, 1% of the loan now. $5,000 at closing gets you your 4.5%. And alternatively, if you don't want to pay a point, I would say your rate is 4.75, and you don't have to pay a point. So the key there is, if you're going to be in that property long term, then maybe it does make sense. Pay a little bit, you pay the $5,000 up front, and you're going to have this house for the next 7, 10 years. And in the long run, yes, you will save. Up front, of course, you come out of pocket for that amount, but it all depends per situation. Again, I can review that with you guys. So, and also when comparing your mortgage payment to your monthly income, I'll go over some ratios and some numbers here of tolerance that you kind of want to stay within. So again, yes, lenders are asking for larger down payments. Again, it all depends on your price point. It also depends on the type of property you're buying. If you're buying your owner-occupied property, the one you're going to live in, that is the one that you can usually get away with putting the least down payment. If you're buying a second home, it's safe to say you're going to have to put a minimum, depending on what price point, a minimum 10, 15% or more. If you're buying an investment property, a 4-unit investment property somewhere on the west side, regardless of whether or not it's a $300,000 loan or a $3 million loan, the minimum down payment for something like that is going to be 20 to 25% minimum. So again, it depends on the occupancy status also. Qualified buyers, again, like I had reviewed earlier, do not necessarily need to put 20% down. And I won't go over V8 unless we have any vets in here, which is great. If we do, I can review that with you guys also. But FHA is the predominant program, again, Federal Housing Administration, that allows you to put as little as 3.5% down. So it's a great program. How much of down payment? Again, I kind of started on this on the previous slide, and I guess I'll touch on these points again. Again, type of property, credit scores you've got, very important. The property use, like I had just mentioned, primary residence, you're going to get the best rate. Second home is going to be the next step down, and then the investment properties. Not only do they require more of a down payment, usually, but the rates and the pricing is also a little bit higher. So if I can give you 4.5% on your condo on the west side, if you're buying an investment property in Vegas, which you shouldn't be, then your down payments are going to be 20, 25% down or more. And nothing against Vegas, just don't buy it right now. Local market conditions, again, higher down payments are required in certain market areas. We're all living here in LA, you don't necessarily need to have that. If you're buying a property somewhere in San Bernardino or Riverside, nothing against those places, but yes, they are weaker housing markets as determined by lenders, which means in theory you'll have to put a lot more of a down payment. Trade-off, larger the down payment, the smaller your monthly principal interest payment will be. Basic math, right? Buy a $500,000 home, if you put 3.5% down, your mortgage payment is going to be higher. If you put 20% down, your mortgage payment is going to be lower. Also, the smaller many of your loan costs will be. If you're doing a $400,000 loan and you want to pay a point, it's going to be $4,000. $200,000 loan, it's going to be $2,000. So again, it's all math. And if you guys don't like math, I do. Call me or email me. I'll do all the math. Closing costs. So again, I reviewed this a little bit earlier. And points are, again, or funds you pay at closing. And this is a good point here. Should you pay points to lower your interest rate? The key here is it depends on how long you expect to actually stay in the house. If you're buying a property and you're going to own it for the next 2, 3, 4 years, you shouldn't be buying a property, right? If you're buying a property and it's going to be 5 to 7 or more years, then yes, then we should talk. And then I will give you the exact numbers. And then I will tell you, for you it makes sense to pay a point or 2 or half or 0. Again, it depends on several factors, your credit scores, what rate you're going to get, how big of a down payment, and for each situation it varies a little bit, but those are the key factors. So again, everything kind of moves back to long-term investment. Compare apples to apples. So again, it gives you some pointers as to what you need to do or what you should do when shopping for a mortgage. Again, get the complete story. Go to several lenders. It doesn't hurt to do that when shopping for a mortgage. And compare all the options and do it apples to apples. So if I tell you, here's your rate with 1 point, and here's your rate with 0 points, the next person you go to, you ask them for the same thing. Say, hey, I got these rates, and I want you to give me the pricing on 0 points and half a point and 1 point, and kind of all of that. This is a good ratio and a factor that I had mentioned a little bit earlier. So, mortgage payments should not be more than 28% of your before-tax income. So, this is just your mortgage payments. I'll add one other number to this, the number that we look at. So, I, as a mortgage banker and as an underwriter, I actually will take your file. Let's say you come to me and say, I want a $500,000 loan, and I have $500 a month car payment, and I've got $500 in credit card bills. What can you qualify me for? The ratio that we as underwriters and bankers look at is 45% monthly debt to income ratio. So this is a different factor you see here, 28%. Should not be, your mortgage payment should not be more than this. But if we add in your car payments and the credit card loans and whatever else you've got, that number should not exceed 45. So basic math, if you make 10 grand a month, your total monthly debt cannot be more than $4,500 a month to qualify for that type of mortgage. And that range, if you're making 10 grand a month, right around 500-600K, if you've got a little bit of debt, is kind of your max ceiling for a loan deal. So 45% monthly debt to income ratio is key. You don't have to remember that. Call me. I remember it. It's in my head, so I'll do the math. What type of mortgage financing should I get? So again, this depends on what your plan is for the property. It's long-term fixed rates are kind of what's back in style right now because a lot of people got burned on the ARM loans. ARM stands for adjustable rate mortgage, which is a mortgage that stays fixed. Again, think twice about adjustable rate mortgages. That's what's called an ARM. They were hot in the news a couple of years ago and still are. So basically what an ARM is it's a loan that's fixed for a certain period. Let's say a mortgage bank or broker quotes you a 5-year ARM. That means the loan will be fixed for 5 years and then will become an ARM, adjustable rate mortgage. And it'll be tied to whatever index they tie it to, which is usually, I won't even mention it, they don't need to. But it's tied to different indexes and bank indexes that fluctuate on a daily basis. They could be high, they could be low. They're all very low right now. And they probably will stay low, but in the long run, they will go up. So again, if you come to me saying, I'm buying my first place and I'm going to live here for 5 to 7 years, and I know I'm going to get married and get a better job and move up, then we could think about doing maybe a 5 or 7 year ARM loan, because those rates are going to be lower than the 30-year fix. And then when we do get married and move into a bigger place, we'll do the 30-year fix. So how do ARMs work? Again, I'm kind of exceeding my slides here a little bit. But that's basically the way they work. They're fixed for a certain period, and at specified periods, the interest rates are subject to change. It all depends on what the pricing does and what the indexes do. So again, short-term strategy on loans are good. If this is, you've got 2 kids and putting them in school, and this is the dream house, an ARM loan is probably not the best thing for you. So, and again, it all depends on your situation, and I can review that with you guys. Questions to ask when looking for a loan. So what's a term of a loan? Term means whether it's a 5-year or 7-year or 30-year loan. That's a very important question to ask. Interest rate is probably even a more important question. What is my interest rate? What is it tied to? When will it change? How long will it stay fixed? Is it fixed or adjustable? That's very important to know. When are the payments due? Payments are always due at the first of the month. There are some mortgages that allow you to pay a couple times a month if you want to. So that question is a little bit outdated, but payments are always due on the first. What happens if I make a late payment? The terms are spelled out by every lender, and they do charge you penalties and whatnot, so be very careful when you are actually approaching a mortgage and getting one. You have the option of including your taxes and insurance in your mortgage payment on a monthly basis. Majority, 90+% of people elect to pay them off their own. But you have the choice of having the lender pay it for you on a monthly basis. What will my closing cost be? Again, as I mentioned earlier, you want to be very clear about that. And again, you want